This is Price Headley. I'm the founder of BigTrends.com. I also have my lead consultant, Chris Sarah, in with me as well to help answer questions. So feel free to type in any questions that are on your mind in the chat box as we go through my top 3 favorite technical analysis techniques. Going to give you a little overview on a few key things I like to look for to really discern which way the markets are telling us they want to go. Whatever type of trader you are, we can really use these techniques on different time frames. So we'll actually show you some multiple time frames here to show you the big picture and then going down to the shorter term charts. Just a reminder, everything that we share with you in today's session is for your information and education only. Even as I'll look at some real-time scans towards the end of the presentation, just a reminder that none of this is meant to be a specific buy or sell recommendation on any particular security. And ultimately, you know that you are solely responsible for your investment decisions. Here at Big Trends, my staff and I are not responsible for any trade you choose to make, and not all Big Trends products or services are appropriate for all investors. So remember, we don't provide any personalized financial tax or legal advice. It's put out as real-time email and text alerts for our recommendation clients. But bottom line is that you need to decide what's right for you and consult with your tax and financial advisor before you make any investment that's going to impact your unique financial and tax situation. So, we're focusing, of course, on the education piece here, basically pointing you in the right direction. You can't hit the target if you're off pointed in a faraway direction. So we'll also share with you a little taste of how I do explorations in the current markets looking at scanning. So how do you, once you take some of these principles I'm going to share with you here, how do you take that and go scan? And then it's all about being able to pull the trigger off of that with consistent execution. So I actually started Big Trends back in 1999. I've been trading since 1990. Pretty much graduated from Duke University, and perhaps thought I knew it all a little too quickly, and then paid some of those early expensive lessons to then start really frankly focusing more and more on technical analysis as a much more objective way to go about it. And I think just about everybody you've seen here is focusing on some form of that with some fundamentals too, but bottom line is technicals are a lot clearer to me. Moving averages is where I started, but what I found is that you get way too many signals. I don't know about you, but I think the biggest issue I face in trading and in life in general is information overload. You've got so much information coming at you with the power of the internet. They say the content is now more than doubling every year on the web because of just so much out there. So you got to know where to focus. So I'm going to focus on my favorite techniques, and I liked a lot of the adaptive bands. I looked at Bollinger bands and a lot of other techniques, moving average envelopes, Keltner channels, etc. But what I found is that I wanted to not just factor in volatility, but also wanted to see who's winning the trend battle, or if there is no trend, where to stay away and move on to stronger trends, the big trends as I call them. So the bottom line here is that I created this indicator called acceleration bands. And actually, the idea of acceleration bands is that most of the time things are going to stay stuck in between those bands like they're supposed to. But you know what? Where is the really unusual profit opportunity? It's when something unexpected and unusual happens here. George Soros talked about it when he made $1 billion shorting the British pound, and is said to have broke the Bank of England back in the 90s for a brief time there. Bottom line is that it's that other rare 5 to what we find up to 15% of the time for a given stock or security where you're getting the best moves in fairly short time frames. You saw we'll look at the recent market drop while stabilizing here recently, that window of just that few days, that quick hard decline where the Dow dropped 1,000 plus points literally overnight, those create a lot of opportunities if you know where to look. Now, Soros talked about the fat tails of the distribution, and all that's saying is that, people assume these events that are supposed to only be happening rarely are basically about 2.5% on each side of the curve, up and down, maybe 5% total. We find that those tails are about 3 times wider. They're actually happening about 15% of the time when you look at a large sample of data. These 100-year floods, if you will, are happening much more frequently to the upside and the downside. The Boombust Cycle, as Soros would talk about, it's a real kind of a feedback mechanism. So a stock that helped me put Big Trends on the map and start to have people see the power of what we're talking about would include a name like CMGI. Now we're going to show you current examples, but this is just kind of more of a sort of how Big Trends got really rolling, was really calling, in essence, the the last wave up of that tech bubble at the end of the 90s was actually the most powerful wave of all. And so the opportunity there was tremendous, as you had just sort of this pile-on effect. And the key of any kind of indicator, because I've been accused of trading the bubbles here with this acceleration technique. I don't mind that as long as I'm on for the phase where the bubble is getting blown up and I'm riding along with that, and my Big Trend subscribers have benefited from that. But I also have to know where to hop out before the bubble starts to really burst, right? So my rule on acceleration bands, these red bands here, would be, you know, not just one close, but actually two closes in a row outside of that what should be resistance in this case to the upside. Says buy the next bar's open. That's what that blue arrow signifies there. That was the middle of November 99. We had actually just recently launched the company, and we're talking about CMGI, and people said, you're crazy, it's already gone up too much over time. And you see what happened. The stock went from, you know, in the neighborhood of about the 65 area on up to more than double. This is just the stock. We're not even talking about options yet, and gave the exit there at about 135. Now you notice that at the start of 2000, everybody's talking Y2K. We had an initial breakout when the computers didn't crash, and people said, oh, that's real. You see what happens here. The second bar down there closed back underneath that band, did not confirm. So that told you at that point it was not a further acceleration to the upside, but actually rather a failed breakout, or what we call a fake out. So the idea of all this is that you've got to know, just like in life and trading, timing is everything, isn't it? The idea that we want to be on when the trend is really powerful and get a piece of that move. And when there's no real trend, I want to be looking elsewhere to where I've got a more significant trend edge. So, and Jen mentions only trading Forex. You can use this same techniques here, Jen, on Forex, on futures, on any type of time frame. This is just meant to be kind of a longer term perspective. And also just to show you, you know, just Bear Stearns, and when it started to collapse there in 2008, I always loved that. It was the investment company was named Bear Anything because it really fulfilled its name and ultimately cratered down to a very low number. Bottom line here is that you can see what we have on this lower panel is actually the acceleration bands in blue now, but we have on the upper panel the percent R, which I'll talk about next, so Larry Williams indicator, that I use in a really different way to show when these things are starting to really break up or down. Now you can see this first move that combined both only had a brief little window under that acceleration band for about maybe 5, and not that profitable a trade, just a relatively flatliner trade. One of the things to see examples is that not every trade wins, okay? Anybody that tells you that they win all the time, not giving you their full history of trades, the reality, or might be going through just a good cycle, but it's never going to lose, and then you load up, and then you get yourself in deep, deep trouble. It's more a reality-based approach that really focuses on, okay, in these markets, what you doing when it's not working. For example, on this second attempted sell, you see it breaking down, victim band did not break. So that one didn't have that same conviction. You see that and breakdown 1 and 2 closes underneath there happen at $69.94 right here. On those down. This was literally one of the precursors finance that happened later in the year with all the Fannie Mae's, just to name a few that we had, Fannie Mae, you know, just a whole lot of big downside opportunities. People is that how many people are tempted to catch a falling knife. I had a buddy of mine call me when it was at $30 before it collapsed the next Monday. It was at 30, and my buddy called. So we're up to 30. Tell a 1 week March call for $6. Get money if that for a week. That's like he said that's like 1,000% annualized. So to catch a falling knife, and this thing's in a free fall. You see, regrets morning when it opened at 3.5, down some 85%. Anything that looks too good to be true probably is, and you don't want to try to catch those falling knives. Really, opportunity on both sides. Now, as I said, I've been accused of trading the bubbles with this technique. It's often used really by those who are on the outside looking at a big move. And I find the acceleration bands indicator really allows me to really see when we're just starting to inflate and going from there into actually key point here, stocks that bubble up also bubble down, trade them both ways. The prior guest got too tall there for a second, and I was like, this was a great example of a stock, crazy Lakeland Industries. Last year, everybody was getting worried about a ball. Last fall, it's already been a year with that. And you can see I've got my acceleration bands as well as NAR, and we're going to talk about today, the CCI, all laid out here. And this is we're parabolic. As the fear of that Ebola started to hit, this company actually made the suits, the kind of hazmat type of suits that everybody was starting to think that everybody's going to need one kind of thing. That's when you get into major fear mode, right? But you can see even from the time of that buy signal there, it was just under $10. We're never going to be at catching the bottom with this technique. We're trying to catch it as it moves from one phase of trend into a much more parabolic phase of trend. And this one just didn't have options. It was just a stock signal. In this case, you see it went from 986, got as high as 2940, and then exited at 2130. Now, so a little more than a double on that Ebola scare play in about 7 or 8 trading days. Now, those don't come along all the time. You can see some of them are quite a bit slower, that show some potential to go and then don't. But the bottom line is that if they don't, you get out and you move on. If they do, you can basically start scaling out of some of your profits, and we've got very set rules for that, and then tightening your stops on the rest, which is going to lead us into, in a moment, the percent R, because percent R, you can see on this chart, is showing a very overbought stock, and then it keeps going up. And that's one of my key rules, is that if it hits overbought on this, this is the Larry Williams percent range indicator, that second panel there. If it hits overbought and then stops there, then yes, it's probably the top of the trading range. If it hits overbought and keeps going up through this resistance at 980, which happened right there at 1003, it's saying that buy the next bars open, because it's saying this is actually not the top of the range anymore. You're starting to see more accumulation. You want to be positioned to take advantage of that. So this is kind of how we start to sync up these ideas. But first, a quick summary on some of the acceleration bands lessons I've learned in more than 25 years of trading. Typically, this is a growth approach. A lot of people I know in these markets are telling me that they're looking for just kind of something slow and steady. They don't really need to have the volatility of a growth stock. But yet, in my experience, whatever type of strategy you like to do, you can really focus yourself on, okay, which one will give you the best rate of return. Usually it's going to be driven off of growth stocks lead on the way up. They go up a lot faster than the market, and when the market starts coming down, they go down faster than the market. To me, that creates opportunity if you know where to look. Areas like biotech, technology in general, medical and health, and then communications. Usually you see that the one fundamental driver that I put a lot of emphasis on is earnings. Earnings surprises. If companies are beating their earnings estimates, and also if they're growing very fast, preferably 25% or more, and a lot of times headed up into the high double digits or even into the triple digits, those kind of earnings growth rates, while they may not be sustainable for many, many years, they can be sustainable quarter over quarter. And you can really see, and it doesn't have to be a stock that's a young stock. I mean, you think about a stock, for example, like Apple. We're going to talk about Apple in a couple different ways here today, but this is off a trade station, by the way. It's just got my different indicators. Let me actually pull up, I'm sorry, the other one I wanted to show you was this one on the daily chart for Apple right here. And what I think is really interesting is, Apple has had some great runs up, and it's also had some nice moves on the downside, including the ones that just hit here more recently. Everybody says Apple is a cheap stock. Everybody says it's got to be a great buy. Well, you can see Apple's had great runs to the upside with the acceleration bands, and we'll get into the percent R next. But it's also had these slams on the downside where it's gotten whacked really quickly for really sharp declines. Now, this one, ever since we saw that gap down on earnings that happened back here July 22nd, guess what? That made it really difficult to really trade the long side for at least this window of time post-earnings, because usually if the earnings are a negative surprise, you're going to see institutions looking to move out of that stock for a little while. In contrast, you saw the positive surprise back in January this year on Apple. It gapped up, and that was triggering a new breakout in percent R even before the last acceleration surge that happened there in the middle of February. And I don't have to catch this whole move. I only need to catch a small part of this move, whether it's on a daily chart if you're more of a position trader looking out over the next month, or if you're a swing trader, you say, well, what happened after that earnings report? Look at how beautiful this thing broke out on the hourly. The percent R stayed overbought through a long period of time. We'll get into that next. And then other confirming tools like the CCI kept on showing a strength of trend. Okay, so we don't just want to have any old uptrend. We want to have strength of trend. Look at this failed attempted breakout this morning on Apple. Notice how the strength of trend wasn't there on something like the CCI. This yellow line was not actually confirming. And you can even see, look at how the bands fail, fail, fail. If we zoom in, you'll see we actually didn't get a single close despite a couple of tests above that purple upper hourly acceleration band. Test, fail, test, fail. No close through there. Intraday trades through there don't interest me. I'm more interested in what happens on a close-to-close basis. And Michael says, this sounds like an approach advocated by Investors Business Daily. I'd say there's something to that. Bill O'Neill certainly is a very experienced and savvy investor. I'd say I probably fine-tuned it down into some shorter-term horizons compared to the CanSlim approach for IBD, but I'm a big fan of IBD from a longer-term perspective, but I want to actually get tangible short-term action signals. Where do you get in? Where do you get out? And so you can convert that investor mentality into now a little bit more of a proactive investor / trader mentality. Usually, interestingly enough, on these names, there's some kind of debate. There's some kind of a question about this stock's got to be overvalued. Those are some of my biggest winners because, like, Microsoft was overvalued through the entire 90s. You know, people were just constantly skeptical about it. It was only when it became a household name, was added into the Dow Industrials at the end of the 90s, that it basically turned into a laggard stock for the next decade. You know, so the idea here is that, you know, the skepticism, the word overvaluation doesn't worry me. In fact, I like it when we have active acceleration signals. So it's a crowd-based approach we're watching here. You know, I just got my business week in from the other week when the market was panicking on the downside, and the latest business week cover before the Trump one was one that had a bunch of bears on it, and it was just all bears on the cover. That's about as bearish of a cover as I've ever seen, because it means that they're really telling you about how bearish this market is. Usually in a longer term sense, when the media recognizes that bear trend, it's probably near the end. Okay, so something to keep in mind as you look ahead, and we'll look at the long-term charts here in a minute too. So you can factor this on any time frame. And usually these are markets and stocks that are breaking out two new highs, and when they retrace, they don't give back too much of their recent gains. They're basically staying in the top, you know, 10 to 20th percentiles of their recent movement. They're really staying strong. And in my studies, over 80% of the leaders in the next 12 months typically were within 15% of their highs when their next upside breakouts began. So the idea becomes, look, we can factor this concept in. You know, for example, if you're talking about a stock on a longer term perspective like Apple, let's go back to that for a second. So if we were looking just at our bands on a stock like Apple, and then we'll get into percent R next, because I like to kind of lay these things together. We've got a kind of a tight time window here today. Look at on the longer term. This is a monthly chart. This will be more for you investor types, but, you know, hey, you might like to put some leading stocks away for a period of a year plus and really take advantage of that, as well as the lower long-term capital gains rate potentially. But you can see, look at what's happening as Apple is breaking out through the prior few phases. Okay, the last move in the 90s, Apple really didn't get as much of that as a lot of other tech stocks did in the late 90s. Of course, with the innovations from the iPod and then the iPhone, you can see then the breakouts that hit here in 04, a little over a decade ago. On a split adjusted basis, the stock was under $2. Now it's $110. But the point is that you can see catching windows from 2 up to 9, and then the next move went from 11.5 up as high as about 30, well, actually about 29, and then gave you the exit officially on the rest at 17.78. So the point of this is, and even if you're wrong on some of these, like you can see this one, the percent R is breaking out, the bands are not breaking out. We'd back off of that in the '08 fake out. Then Apple got hit like everything with the '08 sell-off. And then you can see the percent R and then the acceleration kicking in here in the 30s on up, pushing, as you can see, up to $100 on that particular move. So the idea here is that you can catch these waves, and you say, well, where's Apple now? Well, it had one of those waves. It's actually just at the end of this past month really given us a sign that while that was a really crazy spike intra-month to 92, it closed actually below a trailing long-term moving average, where we'd say, you know what, that would be a spot to hop out there to just preserve capital at 112.76. It's been chopping since. That's a long-term view. We can go from all different time frames, long-term down to very short-term with that kind of a situation. So, we talked about acceleration names, and what I did here, just so you can get a flavor, I always get this question, how are the acceleration bands different from, say, a Bollinger Band? So what I did is I put the classic 20-day Bollinger Bands in the thin red line here, okay? So you can see how fast they race to catch up. Bollingers are really good, I find, in trading ranges. They're going to race too much to catch up, and they won't allow you to participate in enough of a strong trend move, at least for long enough to get the bulk of that move on your side. So that you can see that this one, it started to race, 1 and then 2 closes outside of there, and then you're getting that buy signal right at the close of that second bar. And the Bollinger's even racing to catch up, and it catches up after about 4 or 5 sessions. And then you can even see that now versus the acceleration band here, which is in green, on that upper acceleration band, you can see how we even test right back down to it, even slightly below it, but we use a trailing stop, not just the acceleration band that would keep us with that, all the way until the trailing stop gets hit in here and would tell you to hop out on that kind of violent day on the final part of your position. The big part of the skill of trading also comes in how you manage your capital through that kind of a trend move. What I find, though, too many of you that I've talked to that are basically telling me is that you'll sell after that first quick pop. You'll be happy to say you can't go broke taking a profit. Well, guess what? If you don't get enough out of your really great winning ideas, you're not really optimizing your potential. You can be right and leave a lot of money on the table by basically hopping out too early. So you've got to be careful about that, and that's an example. Other people will tell me, why not trade the extremes of the bands? You can see it came down into that acceleration band support, and then it did bounce, and then it kind of stopped into that resistance. My issue with that, especially when I trade options, is those moves can take too long to develop. I'm looking for maximum speed over minimum amounts of time. So I mentioned percent R, the percent range indicator developed by Larry Williams. We just tweaked it in a different way based on my testing. It showed me that unusual things happen with this very kind of fast oscillator. It's faster than a CCI or an RSI or a stochastic, but it's the same idea. Most people would use it for overbought and oversold. So when I tell you the word overbought, most of you immediately think, ooh, it's gone too far. I don't want to buy it if it's, quote, overbought, right? But the idea here is that what I find is that the strongest trends tend to get stronger and stronger because guess what? It's not just you and me as individual investors. Whether you're trading $10,000 or $10 million, we're all relatively small fish in the bigger institutional pond of billions of dollars that are seeking a home from the big institutions. They want to get a piece of those trends too. They want to be able to take advantage of that. They're not just going to buy low and sell high that you would think. They will tend to pile on over time. They can't do it all at once, so they tend to feed into good trends gradually and steadily, which tends to lead to greater persistence, greater uptrends lasting longer, and then downtrends also being more severe than you would expect. So, Larry developed this idea of percent R using a negative scale, 0 to minus 100 is how you see it on most platforms. And what I found was that I just like a positive scale, more of a grade school scale. If I'm getting 100 plus 100 reading, that's an A plus. That's as good as it gets for a given stock. And so I'm looking at that, but what I'm looking at is that when it goes overbought, rather than just saying, is it going to reverse and flip back down, I'm saying, you know what, if it keeps trending, if it keeps on going through that initial overbought level, then you can get one of these sustained uptrends. Same way on the downside. So here's a case of, you can see the Big Trends toolkit that we use across a few of the different platforms where you can get all of our indicators. That way, you can see when it breaks out and then it closes above there, That's what we would call a percent R buy signal. You see, this is GE, and then you can see the 1-2 on the acceleration bands coming right behind that, also confirming the percent R move. Usually percent R will signal first. The acceleration bands, I've noticed, will tend to confirm it. So you could also use this as a way to start building a position, then adding to it as you get these other indicators confirm it. Now the normal Williams percent R, that's a shorter time frame, you see how steep this little jagged move is right here, back there. That's the middle of January of 11. And what I look for actually is when it just comes out of the overbought mode, this becomes what I call a retest. That's a low point that you reset your stop, and you can also consider buying there if you missed that first wave up. So these retests can become wonderful low-risk entry points. If they violate anywhere on a future close below that, you would hop out anywhere in that circle area. Even by a penny at the close, you'd say sayonara, moving on. You can see on this case where it actually has the next pullback is right in here as it pulls back under that overbought threshold. I used to get worried and get out right on the overbought threshold, but actually I've learned that those overbought thresholds are just oftentimes shakeouts. One of the nice things you also notice about percent R, even with our longer setting that smooths out some of that sort of V up and down, back and forth kind of action in the oscillator, is that it is still more responsive and a little quicker to adapt than, say, your typical stochastic RSI, MACD type of an indicator. But you see also, once it ends, it doesn't mean you're betting the other direction. It just means now you're just on the sidelines. You can see this goes into a chop phase on the right side of the chart, and even as it goes kind of oversold here, it doesn't actually break down initially there. It kind of just stays choppy. So confirmation is really important, and I'm going to show you some other current examples and how we scan for these, just to give you some flavor about how I use this day to day. Basically, confirmation means that you want to try to minimize your whipsaws and stop-outs. You can't minimize all that noise, but you can certainly reduce it a great deal. So I'm looking for what I call filters, things that filter out otherwise, kind of uncertain, fake-out type of conditions. And so, what I do is I use a two-step approach. If I see the first breakout, what I call the setup, that I don't just jump right on the first sign that something's starting to move, because sometimes they start to move and then they fail. And one of the things you have to manage is not just your financial capital, you also have to manage your internal psychological capital. The idea being that you don't want to be hyperactive and then psychologically feeling like you're getting chopped up. You want to make sure that you're feeling like, okay, I'm waiting for that greater consistency and that greater confidence signal with the follow-through, the confirmation point. And so what I say is that setup is a point where you've got to be disciplined. You can't just rush into a trade because you think you start to see a turn in an indicator. You look for price action to confirm that you're on the right side. That's the classic quote from the Reminiscences of a Stock Operator book. It's full of classic quotes, actually, but one of them is Jesse, the character that's based on Jesse Livermore 100 years ago says, there is no bull side or bear side. He says there's only one side, and he says that's the right side. So your job as a trader or investor, whatever your time frame is, to say, you know what, let's get on the right side of the trend. How do we let that trend tell us which side is the right side? And if it's uncertain, we stay away until we get more clarity. So this criteria can really help you dramatically to go find those kind of opportunities. So, a couple of other examples. One of the things that we teach is not just to buy a breakout. Actually, my favorite technique on the percent R methodology, you can see when it goes over bought here, and then you see it's giving a confirmed buy the very next bar when it closes over that first overbought bar's high. So that bar's close on that green candle is a confirmed buy on percent R. You see the acceleration bands happens a little bit later. But then what I like to do is say every time it potentially comes out of this you used to get worried about that, actually thrive on buying retracements, what I call look at a retracement back into data and how many times that low holds on a clean basis. These are all spots. If you see it happening, you're afraid to chase, and there's no reason you're afraid to get too late and then see it snap back against you, right? So what you do is you stay patient. If you just learn this retest technique, I'll tell you in a little bit how you can actually get training on these three favorite indicators.
Hey, Price, we seem to have lost you there.
Yeah.
Okay.
Yeah.
All right, you're back. Cool.
Okay. Okay, thanks. So yeah, basically just the idea being, if you just learn this retest technique alone, if you think it's like too much, I'm trying to jam 25 years of knowledge into one particular session, you can actually study this over multiple sessions I've captured for you. But bottom line is, if I would say one great technique is just the retest, because what I was saying is that if you actually have missed out on big moves when you saw them happening and you're just afraid to get in, I say wait for the retest, allocate a bit of capital. You don't have to load up on any one idea. I never recommend that. But just take a little bit of capital, or start, even you can do it on paper in some of these virtual trade broker accounts, just to get comfortable, get your feet wet in the shallow end of the pool before you start to immerse yourself. But you start to get comfortable, and you see how buying those little dips within a proven uptrend becomes very powerful. Now you see, sometimes eventually it's going to end, and eventually you're going to get stopped out. So like here's another one. We see it retesting right back into those lows, and then a couple days later it does violate. So whether you use stock, or I like to use call options, if I'm buying calls into those dips, then yeah, I'm going to get stopped out on that move, and I'm going to go ahead and say, okay, I'll take a loss on that one, but it's not going to be wrong for very long. That's the beauty of this whole approach, is when you're in one of those situations where you say, okay, look, I know that I need to follow the discipline of, if it's not doing the right kind of setup. You see, I showed you, 6 other prior retracements. The 7th one failed. Does that mean all 7th retests fail? No. It just means that sometimes, hey, 6 out of 7 ain't bad, right? The idea that, you're going to be able to catch some really nice low-risk entries. You're going to be able to catch it back up. In this case, I would typically say, if it's catching a retest, I would probably say that upper acceleration band, if it's below there, now you're trading it in a little bit more of a channel up to the acceleration band. I would be booking profits each time you basically tag the upper acceleration band. You can see, as you get your next new signal here, so here's the second one coming on board. So this is round 2. I'll put a 2 by it. For the first official breakout signal happened way back here, okay, and then the second one's happening over here. And you see, in the meantime, you could have traded multiple retracements into that. So the first setup and then breakout actually happens the next bar right there. Okay, now look, the very next bar after that breakout, how many times have you had it happen where you bought the breakout, and then the very next bar, it's like, oh yeah, I was waiting for you to buy because now I'm going to sell on the market, right? The stock sells back down, and you see it's yet again snapping down underneath this overbought threshold, and you say, guess what? That's where you get another chance to buy the retest right into that low. Notice the next day after buying that retest, intraday you're going to be down a little bit, but by the close it hangs in there. Then it starts climbing and gets back to that upper acceleration band. From within, that's again another profit target area that I would be saying. That's why you want to learn acceleration bands, both for the big breakouts outside of the bands, and also for, if you're in between there, using it as a support, or in this case resistance level, to say thank you very much, I'll book some profits into that likely resistance. So bottom line here is that yes, eventually then the next retest after that, you see if you're catching this one, then 2 days later you're going to get stopped out. So that's the whole goal. If you're wrong, don't be wrong for long. Stop out with smaller losses. If you're right, be able to take advantage of some of these bigger moves here. On the downside, same idea. This is Family Dollar. We lovingly call Fido at times, but bottom line is that you can see here that this retailer, going back in time, you can see the percent R was catching it before the acceleration bands. The setup when it went oversold, and then it keeps going down. How is it that something that's oversold can keep dropping? Well, it's pure supply and demand, isn't it? Just because it's oversold doesn't mean it's got a balance. In fact, oversold can be, you can see here, a really bad thing. I'm not sure, a couple of you saying you're having some audio problems here. Hopefully that's fixed. But basically, that what we're looking at here is, you know what, if I was telling you, hey, be patient and wait for the retest, here's a retest right there. Look at that test right back into that oversold threshold, right on that very sharp rally day. So again, a lot of times those big short covering one-day wonder type of rallies can be a situation in which you actually can take advantage of that and really capitalize on that. So that's what I love to do. Now, you can see in this case it keeps on edging down. In this case, not as fast. It wasn't really in one of those dramatic accelerations. And then you see one of the things that happened, and one of my rules is that, you know what, if you get a windfall, big gap here on this particular bar, I like to book partial profits of at least half of my position into a windfall gap, especially on the downside, because you know that the value buyers might come back. In this case, they eventually did. It went a little bit lower first, and then by the time it hit our retest and then the violation, it was actually a little bit steep. It actually gave the retest and the violation way back up there. So, you know, if you sell part of your profit, part of your position into that violation, sometimes it will end up being a situation in which I'm glad I sold half of it. Other times I'll make even more by riding the other half of the position. A great example of that, let's get some current examples just to give you a little flavor here. Let's talk about oil. Great example with oil. Now, you know, there's a lot of stocks you could trade in the oil space, but the one I would say that we want to focus on here would be USO. So again, I'm trying to figure out, a couple of you say you've lost audio there. Bottom line is that when we look at this and we say, okay, look at USO and how this trade worked. The idea here is that let's just focus on the daily chart, the long-term chart first. This is tracking crude prices. Look at how ridiculously good these signals on the percent are. And then the other tool that I use is a CCI just to confirm sort of the strength of the move, that the C to break down under that lower green line and say, yes, that's a strong trend down. Okay, the acceleration bands are not quite there yet. They're getting there, but you see I've added these other filters in to be just a little quicker about confirming. So from this perspective, the big move down late last year into early this year, and you think, okay, well, how much lower can oil go? It starts to recover. We actually get a short-term little buy. I didn't really do much with that one because we were below the long-term trend line here in white, still below it after the recent bounce. But you see, look at this, that latest move in oil back to early July. There's your percent R setup. There's your follow through. So it's saying to buy, or in this case, buy puts or short the USO at that close, or we use the next bar's open. Even on the gap down, where you see you left a little bit of profit on the table versus the prior day's close, even on the gap down from 1832, this thing dropped all the way down to 12.5. I mean, that's ridiculous. That's basically another 30% haircut in oil prices just over July and much of August. So, you know, and I'd be remiss if I didn't also give you a quick little look at the overall market on the S&P. You know, because, you know, you look at the S&P and what it did here just recently, you know, and you see, okay, yeah, you had the daily chart showing you percent over starting to break down here, and then it did follow through and gave you actually a confirmed sell at the close on that Friday the 21st. Guess what? The next Monday morning, the Dow was down as much as 1,000 points. And you see this was, again, trying to go off of the next bar's open, which, again, I wouldn't tend to chase a gap down like that. I would probably wait for the retest. But bottom line is that you can see now we're kind of back into a little bit of chop. However, if you're more of a swing trader to a position trader, check these charts out. Look at this hourly chart. Let's go back just over the last couple of weeks. You see today it gave a little failed attempt. By the way, the CCI wasn't broken, and we weren't really confirming through that acceleration band. But look at this downside move that happened the 20th and 21st. The percent R breakdown, the bands had broken, this purple band. With this light blue is a long-term Bollinger to compare. All that support is just getting eroded early on the 20th, and we're getting then everything all coming together by late on the 20th. In this case, the S&P is around 205, 204.92, actually 205.05 was the official entry. And you see, it dropped into that Friday down to 197. That was already a home run trade, and then Monday morning it's opening at 187. Now, to put this in some perspective, let's just say that when it was at 205, one of my favorite basic option techniques is to just consider buying an in-the-money option. So if you were bearish 205, you wouldn't want to buy the at-the-money 205 puts. Yes, in this case, they'd probably make you more money, but they're riskier because that's all time. But let's just say you were looking at the even the monthly options that expire in, you know, if you were looking at something like the 208 puts there when we were at 205, well, that triggers back to the 20th right there. That option was trading for like 580. It would cost you just under $600 a contract. You say, gee, that seems expensive. But you know what? For that short little move, just a day later, they were doubled by the end of that next day on that Friday the 21st to $12 from under 6. And then on right off of the open on Monday morning, the 24th of August, they're up to 2260, a high of 2690. You know, you've gone from 6 to 24. That's a four-bagger in 2 trading sessions. And the other thing I would mention too is that if you're a really quick trader, say you like to trade in and out 1 or 2 days, you can do the same analysis on a 15-minute chart. So this is where we line up all these. Yeah.
Quick heads up. You have about 5 minutes remaining.
All right, thank you. So basically, you see here that, when we're looking, I wanted to give some live examples to show you, hey, I'm not just picking out past history. Look at this 15-minute chart sell signal right here. Let me zoom it in real quick. So we just literally look at that little window. You see the sell point that happened here on the 20th, the follow through right away. We've got the break of the bands. You see how we're just hovering down underneath. We're hovering oversold. We're actually never even retesting until right there the afternoon on that Friday. About 2 o'clock, it gave one little bounce, 200.71. That was a low-risk reentry. Again, if you were looking at it for a short-term trade, either just into the close if you're a really quick trader, or if you wanted to take part of it overnight, you can see, again, say it was at 200.71. You say, okay, you know what? Price says buying in the money option. It's a little better choice. We're going out to the monthlies where you're going to lose some leverage, but trying to be sensible here. Even if you're buying something as simple as a 205 put when we were 201 right there. Guess what? Right into that retest, I was trading like 7 1/4. It finishes the day at like 980. You'd be pretty happy if you were just booking that towards the close. Or of course, that next Monday, it's up to $20, $23 high, open at 17.5. So you're still talking about even very conservative options that can double or better with that kind of a move. So we look at these option charts very closely as well as just one other taste that we like to do. Okay. So bottom line out of all this, and is, and part of, once you learn this stuff, the one thing I was going to mention to you as well is the scanning capabilities that you can get from us here at Big Trends. Again, I don't have a lot of time to go through all the scans and radar screen techniques, but the bottom line is that radar screen is a tool I use every day in TradeStation. This takes a lot of securities, and I take something like %R and I say, show me what's bullish and show me what's bearish. And I've got a load of other things on here with the acceleration bands and all kinds of other Big Trends tools. This is called our Big Trends Toolkit. It's on a few of the different platforms. But real quick, just you can see, if I was saying what's really strong here, well, you can see the airlines have been pretty strong. Green means that we've got potential buy signals over that 80% level. And then a little bit careful now because it has earnings tomorrow morning. I'm not going to buy something right in front of earnings and have a we do something different for earnings. If you want to learn an earnings strategy, just check with Chris through our 800 Big Trends line. But basically what this does is it tells me, okay, these are the potential strong names on the longer term. Then I'll filter them down. On the other side, look at what's acting kind of bearish. Teva, that's a generic pharmaceutical stock. Kihu, these are not recommendations. That's a China stock. The BP, oil stocks. You see gold, GOLD. These are names that are breaking down. GDX, that's the gold miner. So literally I could take an idea and I could say, okay, so then I go plot. If I'm looking at GDX gold miners, it's a little low dollar, but you can see it's breaking down a little bit more. But it's there on the hourly. It's not quite there well, it was there right into the 15-minute. These things are okay. It's just that we're testing some old support there around $13. I'd kind of prefer to see that break. But it gives me a watch list to then go check the options, check all this stuff out. Now, from this perspective, we say, okay, you know what? Then how do you take advantage of all this knowledge? So what we've done is we set up this special course for you here, and we call it our Top 3 Bootcamp. And what this does is it basically takes all the 25 years of knowledge that I've accumulated on these indicators, my best of the best, my favorite kind of tools that you can really use up and down, bull and bear markets, any different time frame, swing trade, day trade, position trade, or even if you're wanting to apply it to a little bit more proactive investing approach. And you can start learning those systems in full. These are I went probably an hour and a half on sessions. We're talking definitely over 4 hours total content on these top 3 indicators: %R, the acceleration bands, and the CCI. So what I would say to do is basically when you go to the page we set up there for you, top 3 Bootcamp page, I'll just show you that real quick. You go to that page, Big Bootcamp, and it'll route you to this page here where you'll see all the goodies you get for ridiculously low price here today. We've knocked it down. off here today, 67% off, as you can see here on this top 3 bootcamp page. And so what this is it basically takes you through all those indicators and literally walks you through percent R rules, acceleration band rules, commodity channel index rules, all in for just 99 bucks. To get that, you just hit the add to cart page from that particular link. And so, and Chris has posted that for everybody, so you can go there and check it out. So when you hit add to cart, you get it for 99. If you want to also get the other, it's what we call the next 3, the DMI lines, the efficiency ratio, and the DMI difference, plus the last 3, which is some nice specialized tools, including percent above moving average, the MACD unique way I use that, market timing tools like the put call ratio and VIX, and then a bonus session putting it all together. You get all 10 sessions through that text links there at just 199 bucks all in for all 10 sessions. By the way, this is lifetime access. So you get this for lifetime. It's HD quality. You can really enjoy and watch those again and again and again. So when you just click that add to cart button, it defaults you to the 3 sessions on the top 3 indicators. And if you want to get the other bonus 7 sessions to get a total of 10 sessions for just that extra little bit of add-on, you get it all in for 10 sessions for the 199, or you get the 3 for 99, whichever way you want to go. Just hit the green checkout button, and it'll walk you through what you need to fill out in the bolded lines for your credit card to process. And you just go down there, get your credit card info in, et cetera, check on the terms and conditions box once you reviewed all that. And we're all about, being fully transparent, so we show you exactly through the terms and conditions how it works. Once you get whichever one you want, hit the green submit order button, and you'll be good to go. Now, we do have representatives standing by, Chris and my team, through our 800 Big Trends line at the top right of that order page there, 800 Big Trends. Just remember that, or you can email us through clientcare@bigtrends.com if you have any questions whatsoever. Sorry we had a brief sound drop out there. I know I tried to jam a lot into the 45 minutes or so, but again, there's only so much that I can intro for you, but now with the top 3 boot camp, literally more than 4 hours of content, really getting you all the specifics you can start applying on any vehicle you trade, stocks, options, Forex, futures, ETFs, you name it, it's there for you with these key indicators. Okay, I want to hand it back to Reed, say thanks so much for hosting, great being with everybody, and hope to see you all again real soon.